to our presentation. Our group has 4 members: Hazel, Kane, David, and Gerald. Our analysis based on the major geopolitical conflict between China and Taiwan from 2026 to 2028, which will significantly affect the global airline industry. We will assess industry-wide and airline-level impacts before making our buy and sell recommendations. Now, can we walk us through the impact on the industry?
Talking about the scenario and how it will impact the Asian regions in the various aspects, and of course, aviation sector, there will be 2 periods. The China and Taiwan conflict from 2026 to 2028 caused a direct widespread disruption of broad Asian aviation sector. As the region entered 2029-2032 recovery phase, Singapore played a standout. Its neutral diplomacy, strong international support allowed it to reopen quickly. Taiwan, in contrast, experienced a complete operational collapse with the severe infrastructure damage and financial strain if recovery is slower. So our investment thesis has to depend on the changing in the recovery period, which determine the new global aviation hub. In this new landscape, Singapore leads while Taiwan falls far behind, you can see on the table. Continue with Hazel.
Kane has outlined the industry-wide impact of the shock. Now let's focus on airline-level impacts with our 2 target airlines. The Taiwan Strait handles over 1.5 million flights annually. This geopolitical conflict could shut down this key corridor, disrupting major international routes. It will severely hurt China Airlines, reducing passenger volume and lower load factors. To be more specific, the event would burden China Airlines with significant debt and weak revenue, pushing the airline to the brink. And China Airlines could face operational paralysis during 2026 to 2028. Even if the conflict ends, the recovery is expected to be extremely slow, with poor performance. Now, David will dive into numerical analysis to reinforce our sell recommendation for China Airlines stock.
China Airlines has seen a sharp revenue drop from 9.6 million Australian dollars in 2025 to 4.1 million dollars in 2026, a 57% decline due to the loss of key international routes, rerouting increased cost and reduced demand. Post-war growth is expected to improve slightly from 0.05% to half of 1% by 2029, but still lags far behind the 2% pre-conflict rate. But with only 0.05% annual growth projected from 2030 to 2032. As performance deteriorated, the stock price fell from 1.03 Australian dollars to 0.1 dollars and to 0.05 dollars in the following years. This sharp decline reflects investors' loss of confidence in the airline's recovery prospects. Market sentiment weakened further as operational disruptions show no signs of short-term resolution. With a 72% debt-to-asset ratio, financial pressure is mounting. Given a weak outlook, investors are strongly advised to sell their shares.
During the conflict, passengers might shift to safer hubs like Singapore, with Singapore's Dan network offers safe alternative, making it a key choice for Asian passengers. The airline is expected to remain stable during the conflict. Once the conflict ends, Singapore Airlines is poised for strong growth through the recovery, fueled by rising passengers and revenues. So to support our buy recommendation for Singapore Airlines, Gerald will now walk us through the quantitative analysis.
Thanks, Nghi. In terms of profitability, we are expecting Singapore Airlines to experience a stagnant rate during the shock, due to the direct conflict zone contributing only 10% of the network. After the conflict, we believe that it can recover at a 15% rate before curving back to a terminal rate of 2.5% in 2032, with a 4% increase in net margin after the shock. However, it should be noted that post-shock free cash flow, considering due to more capital expenditure, we will not necessarily have a negative outlook and instead indicate a strong investment to drive future revenue. Moving to valuation, based on comparable analysis with Asia-Pacific carriers and multiple valuation, the price we are expecting for Singapore Airlines is around 8, which implies the stock is traded overvalued. However, taking into account projected cash flow for the post-recovery growth, it is actually undervalued in terms of share price. We projected a 50% upside valuation compared to the current price. The potential upside in valuation can also be attributed to the WACC use, which is currently lower than the theoretical rate of 9 to 10%. A feasible explanation would be a higher beta or market risk premium, indicating higher risk, which we think did not reflect the true risk level of Singapore Airlines, considering the positive outlook post-shock.
On a short position on Cathay Pacific and American Airlines, clearing China Airlines exposure, going long on Singapore Airlines. This is a smart and tactical move in this geopolitical scenario. It captures post-conflict upside while hedging risk from unstable carriers. Aviation is deeply tied to geopolitics and national resilience. So positioning must be sharp and forward-looking. This is the end of our presentations. Thanks for listening.